Appreciate you taking the time out and joining us, Christian. What do you make of this steadfasted resolve of the Indian finance minister to toe the line of fiscal consolidation and continue on that path, even on the debt to GDP ratio number as well for FY27, the budgeted estimate is lower and moving towards the targeted number given of FY31. What do you make of that to start off with this conversation?
Great. Well, thanks for having me. Well, I think the communication is quite clear in terms of the demonstration of that commitment to long-term fiscal sustainability. So yes, indeed, the government has been successful in achieving that 4.5% of GDP deficit target this year, and actually beating that by 0.1 percentage points. But however, I think what we would want to highlight is that pace of fiscal consolidation has slowed considerably. That 0.1 percentage point of GDP improvement in 26-27 is slower than any of the sort of declines in the deficit to GDP figure that we've seen since India emerged from the pandemic. And as a result, I think what we can say is that the path of gradual debt reduction is going to be quite gradual. So put it another way, we think that the debt burden of India is going to remain elevated for quite some time, notwithstanding, again, the government's continued demonstration of fiscal prudence.
Christian, you say that India's budget was tactical but not a breakthrough and does not merit a sovereign re-rating. Explain why you say it's tactical but not a breakthrough.
Well, I say it's tactical because there weren't any very large, sort of groundbreaking types of measures. What you saw here are a series of measures, many of them, related to very specific sectoral specific types of things, as well as certain, projects related to infrastructure, such as improving connectivity. But, there aren't any very large, sort of headline grabbing types of measures that perhaps we've seen in the past. Even just that reduction in deficit consolidation isn't really that noteworthy. Now, we don't think that this progress on fiscal consolidation warrants a rethinking of our sovereign credit assessment at this time, because as I had mentioned, we do think that that debt will remain elevated, and we don't just look at debt to GDP. The other part of our fiscal strength assessment includes debt affordability. One measure of that is interest payments to revenue. And so what you can also see in the released figures, in those released projections, is that revenue to GDP, excluding borrowings, is actually eroding. And that reflects a series of measures that had already been announced prior to the budget, such as the GST rationalization a few weeks back. And so that does reflect the reason why I think there is this tactical nature. The revenue take is actually smaller, so therefore the room for maneuver to support the economy is also smaller. So in fact, I think just broadly speaking, if I could summarize, the deficits will remain wide. It's actually continues to be wider than any of the deficits recorded prior to COVID. The debt will remain high as well, and debt affordability is actually going to worsen a little bit over the next couple of years.